So gold is near $1,800 an ounce. And a lot of people who never bought gold when it was $300, didn't buy when it was $600, said that it was a risky asset, said that it was impossible to value, that it was speculative. They've been wrong for 11 years in a row. Gold has gone up, including 2011, for 11 years in a row. And that is unprecedented in modern history for the gold market. And it is extremely rare for any market to have that level of consistency in terms of its price appreciation. So now a lot of these people who never bought gold and never recommended gold are spouting this idea that gold is too expensive. Now somehow they know how to value it when they claim that it was impossible to know how to value it. Well, gold can easily be understood in terms of its relative values to other assets. Obviously, gold itself generates no cash flow to value, has no earnings, has no interest, pays no dividends, but it is nevertheless thought of, has been throughout history, as money. And gold trades in a ratio versus silver, versus crude oil, even versus the stock market. Back in 1980, when the gold price peaked at $850 some an ounce, it just touched that very briefly in January 1980. Back then, it reached parity with the Dow Jones. Gold and the Dow Jones were both worth about $850. So there was a 1-to-1 ratio. And at the height of the stock market bubble in 2000, the Dow was worth, I believe, about 42 times the price of gold. Today, the Dow has collapsed to the point where it's only worth a little over 6 times the price of gold. So even though the Dow hasn't actually declined that much in nominal terms since 2000, it suffered a crash into March 2009. It has since recovered a lot in nominal terms, but it hasn't recovered anything in real terms, in terms of gold. The stock market is worth less now. The Dow is lower now in terms of gold than it was at that March 2009 bottom. And I think there's a good chance that the ratio could go all the way back to 1-to-1. Another way to look at the value of gold is to think about what it would cost, what the gold price would have to be in order for gold to back all of the monetary units, all of the fiat dollars that have been created into existence. And if you go back to the Bretton Woods system, back when the dollar was convertible by foreign governments into gold, and if you take all the new currency units that have been created since that point, the gold price would have to be well north of $9,000 in order to account for all the new currency that has been created. In order for those currency units to be convertible into gold, the gold price would have to be over $9,000. And that, I think, is a fairly conservative estimate. Obviously, it's not going to jump from its current price to $9,000 overnight just because people decide that the dollar should be backed by gold. But it's an ongoing process of revaluation. And the market is going to force the gold price, through the gold price, is going to force a de facto gold standard back into the dollar. And Ben Bernanke can fight it. Ben Bernanke can deny that gold is money. He can lie about the reasons why central banks own gold. Ben Bernanke has lied repeatedly before Congress and on national television. Ben Bernanke has claimed that the Fed would not monetize the debt. He has denied that the Fed prints money. He claims that it's just it all balances out on his balance sheet, that it has assets and liabilities, and that there's not printing money. There's no printing press printing money. Well, obviously, most of the so-called money the Fed creates isn't in the form of paper dollars. It's in the form of digital computer entries into the bond market and the banking system. So Ben Bernanke has been exposed as a serial liar. He even lies about the reasons why governments own gold. He says, well, it's just because of tradition. It's like, no. I mean, a tradition is Thanksgiving. A tradition is maybe the types of clothes people wear. But gold is regarded as money for its objective qualities, for its inherent physical properties that make it unique and set it apart from all other commodities. It has its value highly concentrated. Gold is fungible. It can be owned by the ton or by the gram. Now, from a practical perspective, as far as a transactional currency, silver has advantages over gold in that gold's value is so concentrated that it works better as a monetary reserve, as a backing for a currency. But silver works better for the individual engaging in day-to-day transactions, buying groceries. It's a lot more practical to buy groceries with a 1 ounce silver coin than a 1 ounce gold coin, at least at today's prices. And I think prices are still going a lot higher in both nominal terms and in real terms, because in a financial crisis, people flee to perceived safety. In a purely inflationary time, that might lift all assets. It might lift real estate, for example. It might lift crude oil. It might lift wages. But we're not seeing wages or house prices rise. We're seeing precious metals rise as a consequence of the Federal Reserve's desperate policies of debasing the currency to try to bail out Washington's massive deficit spending, massive debt of some $15 trillion. And that's just the tip of the iceberg, because there are tens of trillions of more represented in unfunded liabilities that in the next few years will require the creation of tens of trillions of dollars of new currency units in order for those liabilities to be met. So I think if you don't own any gold and you can afford it, that you should still be buying gold even at these prices, as compared to putting that money into a savings account yielding nothing, or putting it into a long-term bond yielding not much more and representing a lot more risk, because when interest rates rise and the risk of default rises, the perceived value or the market's value that it assigns to those bonds will plummet. Bonds can go down just as surely as stocks can. So bonds are a terrible investment at today's interest rates. The stock market is still overvalued on a historical basis. If you look at dividend yields and PE ratios, it is certainly not cheap. I mean, it's not in the same kind of territory it was at the top in 2000 or even in the top of 2007. So if you're a very, very long-term investor, you can still do pretty well in stocks, assuming that we get inflation rather than deflation, which I think is a pretty good assumption, because the political class hates more than anything else the idea of deflation, because deflation means having to say no, means having to deny people the benefits they were promised, means having to actually curtail spending, means ultimately having to default on all the debts. So I don't think deflation in any kind of trend anyway is likely to take place. There may be a scare, there may be a stock market crash that initiates a temporary bout of what is perceived as deflation, but that will be quickly counteracted by the Federal Reserve going into the market and doing whatever is necessary to generate inflation. Ben Bernanke has threatened to drop currency units from helicopters, and in a virtual sense, that's what he will do. But if you don't own any gold or silver, I actually would think you should start out buying some silver, because I think that's what you're going to want to have if the economy really goes to hell and the banks close and you actually need something to barter with. It's going to be silver rather than gold. And beyond its practical uses, I believe that silver has the potential to appreciate on a percentage basis much, much more than gold does. If you follow the gold to silver ratio, over the past several decades, it's been elevated from its historical norm. And if you go back into ancient times, gold tended to be between 10 and 20. 16 is a number often used. 16 times the price of silver. Well, we're going to, I think, revert back to 16 and probably below that, because silver, even though it's much, much cheaper, is actually scarcer than gold in terms of available above ground supplies. There are a lot of ounces of gold sitting in the vaults of central banks, and that gold theoretically could come to the market. There's virtually no silver out there. Most of it is consumed by industry. Now, the bulk of silver demand is represented by industry. So when you have investors coming into the silver market, that represents a new source of demand in addition to the industrial demand. So whereas gold, the largest portions of gold demand are jewelry and what they refer to as hoarding, investment demand. Investment demand is such a small portion of the silver market that even a modest increase in investment demand has the potential to have an outsized impact on silver prices. And right now you can buy silver coins, junk silver, pre-1965, silver dimes, quarters and half dollars at a low or virtually no premium above the spot price of silver. And that tells you that even despite the rise of silver prices to over $40 an ounce this year, that there has not been any panic buying in the retail market. I think that's yet to come. And when there is a panic in the retail market, you will see the premiums shoot up. You'll see people lined up outside coin dealers like they were in 1980 looking to buy silver. We're nowhere near the panic phase in this market. So if you calculate what a true mania is in a stock market or even in gold, silver is much more volatile than stocks or gold. So it is just going to explode. And if you take the highs that we recorded this year in the spring, I believe it was in late April, silver got up to about $49 an ounce. Well, the final high, when there's an actual panic, is going to be multiples of that. I think at least 5 times that. I mean, at least 250. More likely is going to be 10 times. I think we're looking at $500 silver.